If you found a bag with $10 billion today, what would you do?
What I'd do, I would invest it if I had the option, exactly the same way as I've got the Australian Super Balance Plan invested, because that portfolio reflects my best ideas and the team's best ideas of the people I trust. I think in the months I got left, the key thing is to ensure that the people who are doing the day-to-day running the portfolio are really well equipped, have the best skills, and are confident in executing on their judgment. So my job is to work with my people, and they're a great team, to basically for them to do their best in the portfolio and not to be worried about any changes, because their judgment's a good judgment and they'll do a good job. The thing about surfing is that you don't think about anything else but surfing. You're sitting out there, you're paddling out there, and then you're sitting on the board, look at the waves coming and say, is it this one? Is it that one? Or whatever. There's no time for anything else. It's completely mind clearing. And then when you come out and the water's washed over your head and over your face, you sit back fresh and you sit on the beach and you just go, oh, well, that's a job done. That's just fantastic. And that clarity of the mind, clearing of the mind, a lot of philosophies about that and whatever, then sets you up to then take on the more complex or difficult decisions.
Welcome back to another episode of the Allocator's Playbook. Today, I have someone very special with me who, apart from being an exceptional investor, loves the water like I do. Please join me in welcoming Mark Delaney, Chief Investment Officer at AustralianSuper, who is being awarded with a Lifetime Achievement Award at the Markets Group Australia Investors Forum in March. Tune in as Mark and I explore how the geopolitical landscape will change the opportunities set in the market. Hope you enjoy the conversation. Firstly, hi Mark. I'm so glad that you're here today. You're kind of getting a Lifetime Achievement Award at our Australia Investors Forum in March. I kind of wanted to start by understanding the key turning points of your career that have shaped you as a seasoned investor.
Yeah, gosh, you have to look back and think about these things. I think there's sort of been three really important moments. The first one was when I finished university, I went to work for the Australian government in Treasury in Canberra as a professional economist. And the work was really quite demanding and a lot was expected of you at a very young age. And it taught you really to think for yourself, make your own decisions, and try and get things at the highest possible standard. It was much tougher than university, and I learned a lot from that. The second thing was when I went to work in investment management as a researcher, a strategist in my mid-20s. And after that, I went to work doing global fixed income. And a friend of mine said, if you want to go and become a true global investor, you have to become a chartered financial analyst. And I'd never heard of that back in the 90s. It was unknown basically in Australia. And I set off to do this course, which a friend of mine described as Country Fire Authority, as so unknown as it was. But it taught me all the basics of investing. And I still remember being on my holidays and reading the first series of textbooks about how markets worked and how investments worked, and thought this was absolutely thrilling. It was one of the most exciting books I ever read. And I can still picture the graphs and what's going on. And that was sort of generated the absolute love for the whole profession. And then when I came to superannuation in my 40s, in my early 40s, it was a chance to build a whole portfolio rather than a single asset class portfolio. Look at all these different investment types and get to meet the most interesting and fantastic people in the world. So it's been a great journey. Three things: tough time when I first started work, doing my CFA to sort of professionalize myself, and then getting a chance to run an integrated global portfolio.
That's very interesting. And because you've kind of ran me down through the key moments and, the key turning points of your career, what is an advice that you would give a Gen Z CIO who's just stepping in and kind of preparing themselves for the role, kind of working towards it? What are the advices that you would give to them?
Yeah, I think the most important advice is that you're not on your own. There's people you can ask for advice as to what to do, what do they think. And particularly when you've got uncertainty, it really matters. And so asking others, finding a group of willing people you can trust to make these decisions with you really makes a big difference. The second thing, I think, is to just read books, as many books as you can, of what the great investors have done and how they thought about things. The more you read off the best people in the world, the better you'll become. And you can pick up little skills and tips along the way. One of my favorite sayings is one of the Warren Buffett sayings, which is, if you take good management to a bad business, the bad business always wins. It's hard to forget that because it happens so often.
Such a good advice. I think even for somebody just within the business or kind of just trying to enter the space. I think that is such a useful advice. And just for the clarity of our listeners, I would love if you could explain how a super is different from other pensions in Australia and what kind of opportunities are, I want to say, easily accessible to you.
Yeah, it is interesting and different. But there are a lot of similarities between the Australian system and many global systems. We have a three-tiered system. At the base of the tier, there is government-provided retirement savings, which we call our age pension. Now, that is not universal like it is in some countries and is heavily means tested. The second tier is really what you call superannuation, which is where now workers have 12% of their wages put aside into superannuation, long-term retirement savings, which they can't access until retirement age. And that money then is put into superannuation funds like Australian Super, and we look to build those balances to really substantial retirement savings. Some people also have savings balances outside of the super system, outside of the compulsory system, in personal savings, and that's called the third tier. The difference in Australia was this second tier is really the backbone of the system. It was created in the late 1980s and is now a very substantial part, and has really meant that the need for the first tier, the government-provided age pension, has diminished dramatically. And when you have a look at what Australia spends on retirement income compared to many other countries, it spends a lot less and is financially much more sustainable.
Very interesting. Within private markets, where do you see the most growing opportunities in 2026? And could you kind of expand on the strategies and sectors there?
Yeah, so private markets, we're talking private equity, infrastructure, real estate, and probably private credit. They're the range of them. They're a bit heterogeneous, but I'll make some general comments and the specific comments on each of the sectors. If you think back to 2020 with COVID, rates fell a long, long way. After COVID, inflation took off and interest rates came up a lot. So what's really happened is some of these private assets returns, which went up a lot leading into the COVID period, have struggled since then as interest rates have gone up and the cost of financing their debt has become higher. So because they're more highly geared investments, they've had their valuations adjusted. They've performed relatively subduedly since since 2020 right through to 2026. That adjustment process is over for most of them. They've normalized their balance sheets and their financing, and now they're in a much better place, and you should expect to see returns normalize much more to the long-run averages. Real estate is normalized after the structural adjustment of working from home and online shopping. Infrastructure still remains very strong, particularly growth in the new areas. And private equity in particular is one which has attracted the most publicity, whereby returns have been much lower than what's been available historically. But those returns are now normalising as well as the companies have much more sustainable balance sheets. Private credit's the last asset class there, and it's the one which is probably getting the most attention in 2026, which actually would have got no attention back in 2022. So it's gone from being no one paying to being the one at the centre of everything. And that's because private credit is funding to some extent the rise in technology spending and in technology investment on the back of the AI boom, and people are speculating whether or not those loans are good loans and are satisfactory. So there's lots of market speculation around that as to how good these loans are, but generally the AI boom has a long way to go, so hopefully these loans will be met and repaid. The other thing about private credit is that what they call the spread, which is the difference between the risk-free rate and the private credit lending rate, is relatively tight, i.e. narrow compared to where it normally is. And that reflects the fact that there's strong investor demand for these investments. So despite the uncertainties, there's still strong demand, spreads are still pretty tight, but we don't think it's in a bubble.
And so within private credit, you said that you don't think there's a bubble, but there's so much inflow of capital. How, if there were to be a bubble, let's say in a parallel world, how should an allocator kind of navigate that? And what are the early signs of catching a bubble?
Gee, that's a very big question. A lot of ambition in that. We don't think private credit's a bubble. We think spreads are tight, but they're not in a bubble. And then the essence of any credit investment is to work out the credit worthiness of the person you're providing the money to. Do they have a strong enough balance sheet? Do they have good cash flows? And they will be able to repay those loans. That's the essence of it. And it's not so much a bubble per se as really whether they're sufficiently creditworthy to be able to repay those loans when the time comes due. And in all cases, some of these are investment grade and some of these are below investment grade, and just depends upon the quality of the counterparty as to how those go.
And within private credit, what kind of strategies and sectors do you find interesting?
Oh, we really leave that to our managers predominantly. We think they're in the best place. The essence of private credit is not so much to pick winners, but to avoid losers. And the best way to avoid losers is to have quite a diversified portfolio, both across sector and issuer and even sponsors types, so that you get sufficient diversification. So even if something does go wrong, it doesn't affect your overall portfolio. So it's not some investments like private equity, for example, is when you're looking for winners. For private credit, you're looking to avoid losers.
That's a very good approach to look at it. And I feel a big part of investing in private credit is also having the right partners, especially when there's so much inflow of capital. What are a few red and green flags you look for in managers?
Private credit managers, and I'm not an
Yes.
expert on private credit managers, so I'll give a fairly high level answer. You're looking for people who've got a robust investment framework, very good portfolio structure, and really good credit assessment process.
Hmm.
And always a good track record with very few bad loans in that portfolio. If you can get all those, you're pretty well placed.
That's very interesting. And, we kind of also touched a little bit on private equity. I wanted to understand from your perspective, how are you navigating the challenges such as tough exits, slow distributions?
There's been a lot written about private equity, low distributions, and the like. That really comes from the fact that some of the owners of these private equity portfolios, pension plans, are quite mature and they're needing distributions to basically to recycle their portfolio. That's not a problem for Australian Super, which is a still strongly cash flowing, strongly growing cash flow fund, and we're still in the growth phase. So we're looking to deploy. So the fact that we can't exit today doesn't really matter. What we're looking for is to get the best long-term returns. The other thing about private equity really has been, as I talked about at the start, that these private equity deals were pushed up in price in the early these prices have been now normalised since that process, and they've also adjusted to the higher interest rates. So I just think the overall sector looks much better now than what it looked 2 years ago or even 12 months ago.
And what are the sectors and strategies that you find really interesting within private equity?
Yeah, now again, that's a question for the managers. What we want is a manager who buys a diversified portfolio, who has a good deal selection process, a good transformation ability, and can deliver consistent long run returns. We look at their track record. It's not something we set out to do ourselves deliberately.
Hmm. And by any chance, are you tapping into the secondary market at all as a buyer or a seller?
We've looked at secondaries, but we traditionally haven't done them, but they've become increasingly more popular as people look
Hmm.
to get exposure. They're good investments and have become a bigger part of private equity portfolios. But our strategy is to invest in the primary funds and to deploy that capital with high quality managers.
Kind of wanted to just take a beat here and understand which allocator in the space do you admire the most? And does that kind of reflect in your leadership or within your portfolio? Do you take inspiration from them a little bit here and there?
So I'm a member of the Pacific Pension Institute, which is a global pension organisation made up of pension funds, big ones in the world. And I get to see, and a couple of other groups as well, and you get to see the best CIOs in the world right across the globe. And truth is, there's lots of really great allocators out there. In Asia, there's great allocators. In the US, there's great ones. And in Australia, there's great ones. In the Middle East, there's great ones. There's lots of talent at the CIO level running these big portfolios. So we're singling somebody out. I run the risk of insulting all the others, but there's lots of great talent. And when I'm on calls, I was on a call yesterday morning with 15 CIOs from around the world. And we had a very interesting discussion about geopolitical risk and how that influences whether or not you should be changing your portfolio structure. All of them are really good. Now, that said, all my colleagues, all my contemporaries are really great, but the one I really look at the most is Warren Buffett. Have a look at his track record, how long he's done it for, how consistently he's done it, how clearly he can articulate his investment beliefs, and how clearly can he give philosophy about how to approach an investment. He's a legend, and so you do well to study the legends as others like me. Clearly not a legend.
How do you take inspiration from him? Does that kind of reflect somewhere within your portfolio? Maybe his investment style, something that you kind of take from him?
There's lots of things you can take from him. I had a quote at the start about, companies and management. There's another thing I read about how he approaches an investment, which was sort of to look at the 3 or 4 key characteristics. And I thought that was really interesting. And I used it to how you assess investment managers and sort of developed a 3-part criteria. Can you trust them? Are you sure you understand how is now the right time to buy that particular investment strategy? you get those three questions right, you're going a long way to making a very successful investment. So again, I got that idea for Warren Buffett, and there's heaps of others. So that's why I encourage people to have a look at him, have a read of what he does, and then see what could you learn from that to take to your job.
That's actually very interesting because I kind of want to take geopolitical tensions, whatever is happening in the current environment. How are you kind of navigating that within your public markets portfolio?
It's really interesting. You'd have to say that the world has more geopolitical risk now than what it had 2 years ago. Whether that's a reason to change your portfolio is a completely separate question, but you do have to acknowledge that the world has more geopolitical risk. Most people acknowledge that, but by and large haven't changed their portfolios that much. People are faced really with three choices. They can diversify their portfolio more, they can try and take risk off the table, or they can take some insurance policies. Working from the bottom, I really don't like insurance policies because they're expensive and the payoff is uncertain. You're not sure if the risk is going to materialize. Taking risk off the table, there's two aspects as to how it's been thought of in our portfolio. The first one is with regard to the overall equity market. And we're a believer in the AI boom and how things are going. So we've maintained a fairly full weight in US equities right through the last 2 or 3 years when people were selling out. And that's been a pretty good investment for us. In the last 12 months, other sectors have started to come up. And so that tells us that it's probably a case to look for more diversification. And then the other level is what our managers are doing. And our managers are seeking to diversify the exposure across the global equity portfolio. So they're acting on their own fruition in terms of how to manage those risks. So it gets managed dynamically across each aspect of the portfolio rather than having a top-down view that I think there's more geopolitical risk today. I'm going to take my equity weighting down by half.
That's a very interesting way to look at it and kind of navigate. Thank you for breaking that down for me actually. This is a very fun question that I want to ask, and I want to be very mindful of your time here also. And I'll leave it to you whether you want to take it up or if you want to skip that. So, if you found a bag with $10 billion today, what would you do?
What I'd do, I would invest it if I had the option exactly the same way as I've got the Australian Super Balance Plan invested, because that portfolio reflects my best ideas and the team's best ideas are the people I trust. So why would I have a portfolio any different from what I've got here? So I've got my retirement savings invested in that particular portfolio because that reflects the best ideas of all the people I trust. And so I wouldn't do any different.
Okay, okay. You're playing it very safe. I got that. And
It's the
before you
truth,
kind of
though. It's the truth.
Okay, yeah, I thought you would say, you would have like a very crazy sort of an investment made, or you would take like some sort of a very crazy risk in the environment, which would be very off the charts. But I think that's you as a seasoned investor, and that's me as just a beginner of understanding the whole thing. So, one last thing that I kind of want to understand before you step down and, before you kind of let a successor take over, what are a few things you want to get done within the portfolio? Are there any kind of goals between? I know it's a shorter time frame, so any goals between that time or aims to get through?
I think in the months I got left, the key thing is to ensure that the people who are doing the day-to-day running the portfolio are really well equipped, have the best skills, and are confident in executing on their judgment. So my job is to work with my people, and they're a great team, to basically for them to do their best in the portfolio and not to be worried about any changes because their judgment's a good judgment and they'll do a good job.
And lastly, it is very, very difficult for a lot of pensions, especially around the world, to kind of, get a good talent and keep a hold of it. So, how do you retain talent? How do you make sure you choose the right people on your team and, keep them on your team for a longer period of time?
And you're right about talent because investing is really in the business of finding talent, nurturing the talent, and sticking with them over the journey. And that's the case whether you have managers externally or people internally. You really make an assessment about the talent of the person and their team and their ability to execute. We're lucky at Australian Super. Australia's got a pretty deep investment talent base, which we use quite extensively and we're a well-known brand. But we've also got offices in London and New York, and they're very big and deep labour markets. So we can attract and recruit really experienced and talented fund managers. Like in London, for example, we've got a very strong global equities team, asset allocation team, and fixed interest team. And that wouldn't have been possible if we tried to do that in Australia. So having a global platform enables us to access a global talent base and keep them in an environment which we think is more sustainable in the long run. Retaining talent, I think the most important thing for retaining talent is for them to be successful. Investors love being successful and hate not being successful. And so if you can create an environment where they can be successful, where they can bring the best of themselves to work, I think they'll stick around for the long term.
That's very interesting. That's a very good way of kind of making sure that you kind of tap onto a global talent. You make sure everything is in place. Just, I know I've said lastly 2 times now, but I have one more question, and this kind of comes from the conversation we had when we met. So you are an avid surfer, and thank you for talking me into that as well. By the way, I started looking into surfing schools for the summer. So thank you for doing that. But how, as a surfer, what kind of mindset do you bring on the investment table?
You're very generous to say avid. I thought you were going to say average, and I was going to thoroughly agree with that. The thing about surfing is that you don't think about anything else but surfing. You're sitting out there, you're paddling out there, and then you're sitting on the board, look at the waves coming and say, is it this one? Is it that one? Or whatever. There's no time for anything else. It's completely mind clearing. And then when you come out and the water's washed over your head and over your face, you sit back fresh and you sit on the beach and you just go, oh, well, that's a job done. That's just fantastic. And that clarity of the mind, clearing of the mind, a lot of philosophies about that and whatever, then sets you up to then take on the more complex or difficult decisions. If you're tense and stressed and you're worried about things and whatever, you're not in a good position to make difficult decisions, even evaluate things or show creativity, curiosity, and looking for different things. So you won't be a great investor. The ideal investor sits in front of their computer all day, looks with a furrowed brow and works 20 hours a day. They don't make successful people. You also have to have that touch of ability to see. And to do that, you need to look after yourself both physically, emotionally, as well as how you think about your job.
I'm absolutely sold on that idea of that I think any sort of a sport, especially water sport, should be a very crucial part. And after we've spoken, I'm very personally excited to get into surfing and start doing more of it. So you truly have a larger, wider influence, I would say.